Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host Neena Mishra. My guests today are David Barse, CEO of XOUT Capital, and Will Ryan, CEO of GraniteShares. We're talking about a new ETF that GraniteShares launched in collaboration with XOUT Capital. David and Will, welcome to both of you and congratulations on the launch.
Thank you. Glad to be with you.
Sure.
Yeah, thank you.
David, I wanted to start with you. You are well known as the former CEO of Third Avenue Management. You led it for almost 25 years, but in 2015, one of its credit funds blew up and you had to leave the firm. And the collapse of that fund had in fact spooked the bond markets, and it had also led to concerns about a possible run on mutual funds. So tell us a little bit about your background. What exactly happened in 2015 and what you learned from that experience?
Sure. So my background obviously dates well back before 2015. So just briefly, I was a bankruptcy attorney, ended up going into the asset management business, joined a firm then known as M.J. Whitman, founded by a gentleman named Marty Whitman, and helped build at M.J. Whitman an asset management business, which we branded Third Avenue Management, cleverly because we made offices on Third Avenue in Manhattan. That's how we came up with the name. Mm-hmm. And the business was a value-driven, high-conviction security selection business, and we were about identifying value across all spectrums of asset classes: fixed income and equity, large cap and small cap, domestic and international, and simply sought out to build portfolios of best ideas. And over time, created different investment products that aggregated Third Avenue Management into what it became. Mm-hmm. Predominantly, we were equity managers, but we did have a fixed income capability, and that capability grew post the financial crisis, because after the financial crisis, there was certainly an argument that owning credit instruments that were, let's call them value opportunities, higher up in the capital structure of a company, were a safer and probably better way to invest when there were still some uncertainty surrounding whether the equity markets had really recovered. And so we launched the Third Avenue Focused Credit Fund. Mm-hmm. Fortunately, for us, it was quite successful early on, but as the portfolio grew in size, it was indeed a focused fund, which meant that we had a higher conviction, highly concentrated portfolio, and putting that in a mutual fund construct was and continued to be a challenge until we ultimately made what was the decision in the best interests of the shareholders to close the fund. Mm-hmm. The lesson learned, to answer your last question, from that experience and what has really transformed me into what I'm doing now in XOUT is high concentration and high conviction in portfolios that might not have liquidity profiles that meet the daily liquidity requirements of a mutual fund. Mm-hmm. is a bad idea.
Okay.
And diversification is really the only way to protect against the mismatch between your underlying asset and the underlying fundamentals of the fund construct. And so XOUT is a natural progression for what I learned from that lesson to create a wildly diversified offering through GraniteShares' ETF by taking a broad-based index. In our case, the first index is the largest U.S. market cap companies, and offering investors an opportunity to achieve what we view will be a better performing offering because of our methodology of eliminating companies from that broad index.
So as you mentioned, Third Avenue was known for profiting from beaten down investments. It was focused on value-driven investments, and that included distressed bonds, private equity investments, and these were actively managed strategies. And as you mentioned, they had concentrated bets on relatively few positions. So could you tell us a little bit more about XOUT Capital and this move from active management into indexing?
Yeah, so another quite important lesson about active management, and certainly the high conviction nature in which we managed our portfolios, is you're evaluated, and you ultimately are evaluated both on how you perform on an absolute basis, but certainly against an appropriate benchmark. And when we launched Third Avenue at the beginning, our benchmark was the S&P 500. Mm-hmm. As time evolved and our portfolios evolved into different securities, the benchmark by which we evaluated ourselves evolved. And whether that's an appropriate way to express how you're doing to the investors and the marketplace or not is an open question. I'll leave for your listeners to decide, but I will tell you that changing benchmarks to try and make your own investment performance better isn't necessarily a great strategy. What led me to XOUT was a little learning that no matter what benchmark we evaluated ourselves against, ultimately performance was the key measurement. And we were unable to beat benchmarks, those benchmarks, whatever benchmark we actually chose to assign ourselves to. And if we go back to the broadest, the way we started, the S&P 500, if you can't beat that benchmark as an active manager, then you really shouldn't be in the active management business, because that's what you're offering your investors to do. And so my learning from that is the reason we couldn't beat it, there's a whole bunch of reasons, but one of the primary reasons was the nature of the business had really changed structurally post the financial crisis, and the amount of flows that were building up in passive strategies made competing against them a real challenge. And so XOUT, the index, using a rules-based methodology to attempt to perform better than our underlying constituent, that is the largest 500 companies, is in my opinion, a better way of doing better for your investors. And I believe that GraniteShares came to the same conclusion. That's why they launched an ETF to do that.
Mm-hmm. So investors love disruptive technology themes. And in fact, there are many ETFs that provide exposure to disruptive technologies, and some of them are really popular, like robotics and AI and automation ETFs. And then there are some long-short ETFs too that go long potential winners and short potential losers. But your ETF follows a different methodology. It avoids losers. So tell us why avoiding losers makes more sense than picking winners. Is there any research on this approach? Is there any backtested performance?
And there's a white paper that has been produced by the EQM firm that helped us create the index that I would direct you to, that provides you with some information that might help answer that question. But I would tell you that there isn't much in the way of academic research yet, but that's something that I believe will be developed in the not-too-distant future. And what I think one can intuitively comprehend is that it is really hard to consistently select winners. To identify in a large cap portfolio who those winners are going to be, you have to be a pretty skilled individual. But I would posit to you that it is far simpler to simply exclude the losers. You mentioned long short as a strategy. That's also a very complicated thing to do because shorting a security is very different than simply not owning it.
Mm-hmm.
Shorting is expensive. Shorting is very much time required. In other words, you have to be perfect on your market timing. It's a tax inefficient way of making an investment conviction bet. And so simply by not owning something, it's much, much easier than trying to select winners. And the only proof we'll be able to offer to you over time will be whatever alpha we generate in our portfolio, in the ETF over time. But the academic support for that doesn't exist right now, which is part of our edge. I think one of the things that's surprised me was, why isn't anybody doing this? Mm-hmm. Right? Why are we the first mover, if you will, in this kind of strategy? And I think it's because most individuals who are in the asset management or financial service businesses are trained to pick winners. Right. That's what we're all about, right? Mm-hmm. Everyone wants a winner. Everyone wants to figure out how to pick a winner. They want to beat others who are trying to pick winners. There's nobody out there simply trying to exclude losers, from what we can tell.
Mm-hmm. So I would definitely encourage our listeners to visit your website to look at the white paper that you mentioned, but I would add that back-tested performance is not a guarantee of future returns. Now let's talk about your index. It's a rules-based index. Tell us how this index is constructed. Tell us about selection and weighting of its constituents.
Yes, so we begin with, as I said, the 500 largest U.S. listed companies by market cap, and we apply, there are actually 9 factors that aren't factors in the sense of fama French factors. These are fundamental economic metrics that we apply to all 500 companies, and we create a score for every one of those 500 companies, and we take the 250 lowest scoring companies and exclude them. Mm-hmm. And those 9 financial metrics that we use are financial metrics that we've studied and selected that lead toward the theme we're seeking to address, which you alluded to earlier, but we're very different from what you alluded to, which is, what is technology disruption doing to companies today? We would posit that on a forward-looking basis, the most significant risk that companies are facing is technological disruption. And so by studying a slew of different financial metrics and coming up with our 9 that we've selected, we think we've identified a method to negatively screen out those companies that are just not doing as good a job with that forward-facing risk.
Mm-hmm. So let's look at the portfolio of the ETF. Technology is about 32%, which is not surprising at all, because most technology companies, they are benefiting from technological disruption, and they are in fact driving technological disruption.
Well, can I interrupt you?
Sure.
IBM, which is arguably a technology company, although it's probably more of a hardware company than a software company, but it is X'd out currently.
Okay.
So I don't want the listeners to think that we're simply overloading this portfolio. And again, we're really focused on what's excluded, not what's included. Okay. But this is not a technology fund by any stretch of or index by any stretch of the imagination. Okay,
sure. But technology gets a higher weight in the portfolio, 32% versus 23% in the S&P 500 index. Financials also get a higher weight, about 20% versus 13% in the S&P 500 index. What surprised me was energy, which gets 6.4% weighting in the portfolio versus just 4.3% in the S&P 500 index. And looking at some of the high-profile exclusions, I think you are better equipped to talk about them. But I see that Walmart is not there, Disney is not there, Berkshire Hathaway is not there. GE is another low notable exclusion, but GE makes a lot of sense. Walmart may surprise some listeners because they have been investing a lot in their digital transformation. They acquired Jet.com. They are trying to compete with Amazon in e-commerce. Disney also launched its streaming service. They are also investing a lot in transforming the company. So tell us a little bit about some of the high-profile losers and this difference in sectors.
Yeah, and I think we should also highlight for you that the portfolio is rebalanced quarterly. So while we can talk to these specific high-profile names, it may be that next quarter they're in the portfolio.
Okay.
So take the comments that we're making with the view that this is what's there today, but it may not be tomorrow, right? In the case of, you mentioned GE, even in our back tests, which I agree with what your statement was earlier, don't rely on back tests, but our back tests, we had never owned GE. And if you look back in time, even to 2017, when Jeffrey Immelt was running GE, it was featured prominently in financial publications, including the Wall Street Journal, as being one of the preeminent leaders in technology-savvy investing because of all of the different businesses that company had aggregated together and how he managed that process. Lo and behold, today, as you mentioned, GE is a logical one to exclude. I'm not suggesting to you that a company like Disney today, which is spending a lot of money on R&D and adding other businesses to its platform, isn't going to one day pan out and succeed for them. But certainly if it isn't, because some of the other, let's call them more aggressively investing technology companies like Netflix, which has been taking subscriber business away from them for years, will end up impacting Disney over time. It remains to be seen, but the current scoring of Disney ended up making it an XOUT company.
Okay.
So look at it today, but think that the future, it might be different. And that's the beauty of what we're doing, because we're relying on real-time, financial information as and when it is delivered to us. And we are using metrics that make it really hard for companies to, let's just say, fudge the kind of financial performance that the street is used to seeing.
So looking at the top holdings, Microsoft 6.3%, Apple 6.3%, Amazon 5.3%, Alphabet 5.2%, quite similar to S&P 500 index with some of those exclusions that we discussed earlier. So I wanted to switch gears a little bit and talk about expense ratios and expense ratio of this ETF too. Your company, GraniteShares, is best known for its low-cost commodity ETFs, including your gold ETF and platinum ETF. And in fact, your gold ETF, ticker symbol BAR, it is one of the cheapest physically backed gold ETFs, and it has been very successful, mainly due to its low expense ratio. It has more than 585 million in assets as of now. XOUT has an expense ratio of 60 basis points, which is rather expensive, not too expensive for a thematic ETF, but of late we have seen some thematic ETFs with very low expense ratios too. So tell us why investors should consider XOUT.
Well, I think from my perspective, you've got to think about the strategy and the intellectual property and the effort that is involved in designing an index like this. So, what you're kind of inferring in that, in that opening there is that, a vanilla index such as the S&P, for example, because that is should arguably be free, because there's no IP or intellectual property involved, no complicated design. It's just a basket of stocks that represents the market. And as we've seen, the market in terms of pricing power has, consistently priced those vanilla index products down to zero. And so I agree that if there is no IP, if there is nothing unique, nothing special about what you're doing, it's commoditized and it therefore charges or commands a commoditized price. I think the difference in a strategy like XOUT is that, the design and the architecture that goes into that is a very sophisticated strategy. So if you think about any kind of strategy that's designed to outperform a market index, you've got, clearly hedge funds at one end of the spectrum charging 2% and 20% incentive fees. But more broadly, you have the whole class of, active managers, traditional active managers charging, 1.5% to 2%. So we think that, combining an index like this, with the new technology in terms of the ETF wrapper and charging just 0.6% actually is very good value when you consider, the strategy itself versus its sort of traditional peers. And indeed, just a quick point on this, that, as of, I think, the close of business yesterday, XOUT, the fund, I'm not talking about a backtest here, I'm talking about the fund, live performance. The fund has added 65 basis points of alpha over the S&P 500.
Oh, that's
So,
great.
that's pretty phenomenal in the space of a fund that's been around just for 3 weeks.
Mm-hmm.
Now, obviously, that doesn't mean that, that performance is going to consistently continue. That's not a prediction of future returns, but it's just to try and demonstrate that this is doing something different than a vanilla index fund. And again, I would argue that, the price point of XOUT, again, is very competitive versus other funds in the market. But again, people will have to make their own assumptions about that. But I think that for what is effectively an active strategy, but within the new technology, the chassis of an ETF, it's very competitive. And of course, the inflows that we've seen, since the beginning would seem to indicate that investors feel the same.
Okay. So tell us how investors should use XOUT in their portfolio. Is it supposed to be a core holding instead of, say, an S&P 500 ETF? Or is it supposed to replace the thematic ETFs in their portfolio?
Well, I mean, my view is this is absolutely not a thematic ETF.
Okay.
And again, you have to think about what is the core principle of XOUT. And as David is articulating, this is a fundamentally driven, multi-metric strategy that is designed to exclude companies that are believed to underperform or to be in secular decline. So the scoring methodology doesn't care whether the company is a tech company, whether the company is a utility, or whether it's a industrial. It's about scoring the 500 largest companies and excluding the 250 most likely to underperform with lower scores. So contrast that to a thematic ETF. A thematic ETF is trying to give you exposure to a particular theme.
Right.
And any number of those particular themes we could talk about. But the bottom line is it's trying to engineer a particular sector exposure, a particular tilt towards something. That's not what XOUT is trying to do. XOUT is just saying that, as a core holding, so to directly answer your question, in my mind, this is firmly a core replacement. And the reason why we've been talking about, passive investing and vanilla indexing is because for the most part, the market's given up on trying to outperform by picking winners. That's why you're seeing all this flow of money into traditional market cap weighted ETFs, because there's a large part of the market that has simply given up on the idea of being able to outperform the market by traditional means. And so what XOUT is trying to do is to say, well, rather than trying to find the next Google, which we all know is an incredibly difficult exercise, What's easier is trying to isolate and identify companies that are not performing well. And let's exclude them. And by doing that, we feel we have a better chance of outperforming the broad market than if we try and pick winners.
Okay.
And so this is a core holding. This is a replacement strategy for a vanilla market cap index, a core active index. However you get your large cap equity exposure, this is a new way to think about large cap investing and is 100% a replacement strategy.
Okay, excellent points. That's all we have time for today. David and Will, thanks again for joining us.
Thank you.
Thank you very much.
Thanks for listening. If you want to learn more about this ETF, please visit GraniteShares.com. Make sure to be on the lookout for the next edition of ETF Spotlight, and also make sure to subscribe. If you have any comments or questions, please email podcast@saks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.